welcome everybody. Today is March 21. Just a reminder, next week, Headline Roundup will be recorded as I've got some travel planned. We will be back live again on April the 4th. So that said, let's go ahead and just jump in. A lot going on. I've got some interesting perspective, I think, to share with you today, or some interesting perspectives, I should say, plural, to share with you today, based on what's going on around the world now. So what I want to talk about this week, I want to ask, are we about to see the end of the petrodollar? For those of you that are not familiar with the petrodollar, I want to talk about how the petrodollar came to be. And what this really is a preview of the April You May Not Know report that you'll be getting in your mailboxes by mid-April. Of course, one of the risky things about writing a newsletter 3 weeks before you read it in today's environment is that a lot can change. So I thought I'd give you just a preview of what you could expect. Also, Jim Rickards, past guest on the radio program, has some interesting perspective, and this is what I was referring to at the outset, on Russian sanctions and how the U.S. dollar will be affected. And Larry Lepard talks about a crack-up boom, and that term crack-up boom is probably familiar to just about everybody on today's Headline Roundup webinar, as it's a term that was originally coined by the Austrian economist Ludwig von Mises, who described a crack-up boom. So I'll talk about what that is and why Larry Lepard and why I think that is a possible economic outcome here. As I go through the material today, on the right-hand side of the screen, as we have every week, we have a box that says type your comment. So if you have a comment or question, please go ahead and type it into that box as we go through the material. And I want to say thank you also to everyone for getting the message out about our resources. The radio show now has 68,000 listeners every week, and participation in the Headline Roundup webinar is growing every week also. So again, thank you guys for helping us get the message out. That said, this was an article that was published in the Wall Street Journal last week. You'll see the headline on the article reads, Saudi Arabia considers accepting yuan instead of dollars for Chinese oil sales. So the yuan is a unit of the Chinese currency, which is officially known as the renminbi. So the official currency of China is the renminbi. The yuan is a unit of currency. To compare that to dollars, our official currency is the US dollar, and a dollar is also a unit of currency. China just labels the unit of currency with a different name than the official currency. So most times when journalists use the term yuan or renminbi, they use the terms synonymously, as if they're interchangeable. So most times when you read a story, that's what the intent is. So this is just a bit from the article. Saudi Arabia is in active talks with Beijing to price some of its oil sales to China in yuan, people familiar with the matter said. A move that would dent the U.S. dollar's dominance of the global petroleum market and mark another shift by the world's top crude exporter toward Asia. The talks with China over yuan-priced oil contracts have been on and off for 6 years, but have accelerated this year as the Saudis have grown increasingly unhappy with decades-old U.S. security commitments to defend the kingdom, the people said. And I'm going to talk to you a little bit about how the petrodollar came to be here in a moment, because the backstory is really helpful when understanding where we are now. The Saudis are angry over the U.S.'s lack of support for their intervention in the Yemen civil war and over the Biden administration's attempt to strike a deal with Iran over its nuclear program. Saudi officials said they were shocked by the precipitous U.S. withdrawal from Afghanistan last year. Now, China buys more than 25% of the oil that Saudi Arabia exports. If priced in yuan, and currently they are priced in dollars, but if all of a sudden these sales were priced in yuan, China's currency gets a really big boost. Now, the backstory, and this is from the April You May Not Know report, the fact that Saudi Arabia prices all of its oil exports in dollars may not seem like a big issue, but it's a really big deal. And it's really allowed the United States to spend at a significant deficit level for a very long time. Now, if you go all the way back to 1944, there was a worldwide monetary agreement that we've referenced here many times. It was called the Bretton Woods Agreement. And it was the Bretton Woods Agreement that made the US dollar the world's reserve currency. And reserve currency just refers to the fact that the world would reserve or inventory US dollars to use in international trade. So when you hear the term reserve currency, it's just the currency that is inventoried so that countries can trade with each other. It's a universally used or almost universally used currency worldwide. So back in 44, the United States dollar was made the world reserve currency because, as you'll see in a minute, it was backed by gold. So the crux of this agreement was that any foreign entity that possessed US dollars could exchange those US dollars for gold, and the exchange rate was 35 US dollars to an ounce of gold. So if you had a 20, a 10, and a 5, you could bring that to the US Treasury and get an ounce of gold. Well, because the currency was fully backed by gold and fully redeemable for gold at any point, the rest of the world was extremely comfortable using US dollars. Now, when the Bretton Woods Agreement was implemented, the United States had more than 20,000 tons of gold. So this gold store, if you will, these gold reserves collateralized the Bretton Woods Agreement promises. Now, over time, not surprisingly, the Washington politicians overspent and overpromised. By the 1960s, there was another expensive war going on in Vietnam, and Congress and President Johnson birthed the Medicare and Medicaid programs, and there just wasn't enough tax revenue to cover all these expenditures. So what did they do? Well, they began to create currency. And they created so much currency that there wasn't enough gold to back it. Well, Charles de Gaulle in 1965, he was the president of France at that time, warned of an inevitable monetary crisis because the United States was just spending more money than they were taking in tax revenues. And this is de Gaulle gave a speech in 1965. I'm going to give you just a couple paragraphs out of the speech because it's interesting. He said, the fact that many countries accept as a principle dollars as good as gold for the payment of the differences existing to their advantage in the American balance of trade, this very fact leads Americans to get into debt and get into debt for free at the expense of other countries. Because what the U.S. owes them, it is paid at least in part with dollars they are the only ones allowed to emit. So de Gaulle was essentially saying, look, they're creating these dollars out of thin air, and they're using them to pay off their debts, and they don't have enough gold to back it all. Now, he went on to say, considering the serious consequences a crisis would have in such a domain, we think that measures must be taken on time to avoid it. Now, keep in mind, this is in 1965, 6 years before Richard Nixon eliminated the link between the dollar and gold. De Gaulle said, we consider necessary that international trade be established, as was the case before the great misfortunes of the world, on an indisputable monetary base, and the one that does not bear the mark of any country, which base, in truth, no one sees how one could really have any standard criterion other than gold. So in 1965, de Gaulle said, wait a minute, the United States is creating too much currency out of thin air. We really need to revert back to an honest gold-backed system. Well, France was one of the first countries, along with Germany and Great Britain, to say, hey, here's your dollars, give me my gold. Well, by 1971, again, 6 years after the speech that de Gaulle gave, after countries continued to exchange their U.S. dollars for gold, the gold reserves of the United States had dwindled by 12,000 tons. And you see a chart there from Gold Switzerland. In 1960, and incidentally, the last time the United States gold reserves were actually audited, as you see here, was 1953. Now, that fact alone should make any reasonable person a little bit skeptical. I mean, if you really have the gold you purport to have, you would not object to an audit. In fact, you would probably be doing audits just to show the rest of the world that you actually have the gold that you purport to have. By 1971, we know that the United States had their gold reserves drop to 8,000 tons from 20,000 tons. And then in 1971, as we've talked about many times, President Nixon went on television and temporarily suspended the ability to convert the U.S. dollar to gold. And of course, Nixon blamed international currency speculators. Now, as we all know, these international currency speculators really didn't exist. But given the run on the bank that was taking place, given that countries like France and Germany and Great Britain were saying, hey, here's your dollars, give me my gold, Nixon really had two choices. Choice number one, you renege on the Bretton Woods Agreement and say, we're not going to back our dollars by gold anymore, or you get your financial house in order and operate with a balanced budget. Well, predictably, Nixon decided to renege on the Bretton Woods Agreement. Now there was no reason for foreign governments to inventory U.S. dollars. Well, if you're a free spending politician residing in Washington, D.C., that creates a huge problem for you. You need a system to keep demand for U.S. dollars high around the world, even though you couldn't possibly back the U.S. dollars by gold anymore because you created way too much currency and the gold reserves had dwindled. The only way you're going to continue to back the dollar by gold is to change the rate at which dollars could be redeemed. You'd go from $35 an ounce to something higher. And the Bretton Woods Agreement already did that. In 1933, the dollar could be exchanged $20 for an ounce of gold. Bretton Woods made it 35. Now it'd have to be some bigger number. Well, what happened was by 1974, the petrodollar was established. And Jerry Robinson wrote an article about this. He's an economic research director at FTM Daily. And I'll give you just a bit from his article because it gives you a terrific overview as to how all this was put in place. In the early 1970s, the final vestiges of the international gold-backed dollar standard known as the Bretton Woods Agreement had collapsed. Many foreign nations who previously agreed to a gold-backed dollar as the global reserve currency were now having serious mixed feelings towards the arrangement. Nations like Britain, France, and Germany determined that a cash-strapped and debt-crazed United States was in no financial shape to be leading the global economy. They were just a few of the many nations who began demanding gold in exchange for their dollars. Despite pressure from foreign nations to protect the dollar's value by reining in excessive government spending, Washington actually did the opposite. They continued to live far beyond their means, and the rest of the world saw very, very clearly that the United States did not have the fiscal discipline to prevent the destruction of the country's own currency. So America had figured out how to game the global reserve currency system for its own benefit. That's why de Gaulle said the United States continues to get in debt for free at the expense of other nations. So the United States and, of course, the U.S. citizens liked the fact that they could live excessively at the expense of other nations, but now, with the gold standard now being a thing of the past, they had to come up with something and come up with something quickly. So because dollars for gold was no longer sustainable, they came up with this idea of the petrodollar. So what happened, Secretary of State Henry Kissinger, the Treasury Secretary at the direction of Richard Nixon, made a deal with the Saudi royal family. Now, there's a number of authors that have written about this. William Engdahl has been a guest on my program, and I've chatted with him about this. Some of his books on this are fascinating as well. But the agreement was simply this. The United States would offer military protection for Saudi Arabia's oil fields, and the United States also agreed to provide the Saudis with weapons and guaranteed protection from Israel. Well, the Saudi royal family jumped on board. They said, yeah, we would love that. What do you want in exchange for the weapons and the military protection? And the United States said, hey, we need two things. One, you've got to price all your oil, any oil you export, any oil you sell, needs to be priced in US dollars. You can't take any other currency. Second, you've got to be open to investing your surplus oil proceeds in US debt securities. You have to help us finance our deficit spending. Well, that essentially was the deal that was put in place, and it was fully functional by 1974. So it took 3 years to transition, which by currency evolution standards is very quick. And by 1975, just a year later, all of the other oil-producing nations of OPEC said, hey, let us in on the deal. We'll price all our oil in dollars, and we'll buy government debt securities. Just give us the same deal. So that's what's happened really over about the last 50 years. But now that is changing. And in the April You May Not Know report, I made this note. When the link between the US dollar and gold was eliminated in 1971, the United States was really at a crossroad. They either had to get their financial house in order or invent another monetary system that would allow the US dollar's dominance to continue and allow the US government to continue to get into debt for free at the expense of other countries. And again, I'm quoting Charles de Gaulle there. Now, this shift away from the petrodollar has not officially occurred, but in my view, it's just a matter of time. This will have to happen. And when that shift occurs, we will finally have no option left to allow the getting into debt for free party to continue. This will likely mean an even weaker US dollar, and it will be more fuel for the inflation fire. So I believe this is where we're headed, and that Wall Street Journal article tells us that we may be getting close to the beginning of this time frame. Now, with what's going on in Russia and Ukraine, there are also implications for the US dollar. Now, I'm not going to get into politics or the geopolitical situation. I want to look at things purely from an economic perspective, since our focus is how will this affect you and your money. We could look at things from a different perspective, but that's how we choose to look at things on these Headline Roundup webinars. Now, Jim Rickards posted this last week as well. The U.S. and its allies in the European Union and others around the world have imposed the harshest economic sanctions on Russia that have ever been used. In the past, even nations directly at war with each other would continue to pay the debts they owed each other. So he said, this war is in Ukraine. Let's look at another war that took place in present Ukraine from 1854 to 56 during the Crimean War. Britain and France were at war with Russia, yet throughout the war, the Russian government kept paying interest to British holders of its debt. The British government also kept paying its debts to the Russian government. One British minister said civilized nations should pay their debt even to an enemy during wartime. But things have changed. The United States now and its European allies outside of Ukraine aren't even directly at war with Russia, but yet they've still imposed the most punitive sanctions in history. The Russian economy has been cut out of the global economy. Russia has been kicked out of the SWIFT global financial telecommunication system, That's how international trades are settled. It's a U.S. dollar-based system. We've talked about it in past Headline Roundup webinars. A long list of Russian banks, oligarchs, and other major companies have been listed among those who cannot transact with Western parties. Biden has also prohibited exports of semiconductors, high-tech equipment, and other technology to Russia. When you add it all up, we should expect a decline on the order of 25% in Russian GDP in the first half of 2022. That's massive. That's a depression-level decline. Even when the kinetic war is over, Rickard speculates probably in a month or so, the economic war will continue and the effects on the global economy will last for decades. Rickard said Russia is not a punching bag that will take hits without hitting back. They'll fight the sanctions with both retaliatory measures of their own and with inventive workarounds designed to defeat the sanctions. For example, Russia is teaming up with China to roll out the Chinese credit card for Russian consumers. This is a Union Pay card. This comes after Visa and MasterCard ended all business with Russia. So what did Russia do? Here's a substitute. We're going to use the Chinese company Union Pay since Visa and MasterCard stepped out. Russia is now working with banks in China and India. I reported on this a couple of weeks ago that there's a ruble-rupee payment system being established for trade between Russia and India. And Russia is working with both China and India to reestablish hard currency payment channels. There's now proposed legislation in the U.S. Senate to freeze gold reserves held by the Central Bank of Russia. As Rickards points out, this will do nothing because the problem is the gold is physical, about 2,300 metric tons, and is stored in Russia. The U.S. doesn't have any authority to freeze it or seize it. The legislation would impose secondary boycott sanctions on any party that assists Russia in transporting or transacting in gold. But this is an easy sanction to evade, Rickards points out. For example, if Russia puts 100 metric tons of gold on a plane and they fly the gold to Beijing in exchange for manufactured goods, they're not going to issue a press release about it. That transaction will go undetected by U.S. intelligence. Gold is an element. It's easily melted down and re-refined into new gold bars with Chinese markings that are untraceable. The Central Bank of Russia can then buy more gold from Russian miners for rubles to make up for the shipment. And again, that gold is untraceable. Rickard says this: if this is the best the U.S. can do, then Putin is not only on his way to winning the shooting war, but he may win the financial war as well. And here's what I wanted to bring out. Here's what I want to bring up. This is how this may affect you. Russia has also implemented capital controls that will shift the pain of sanction from Russian borrowers to Western lenders. These Western lenders will now suffer defaults on the Russian bonds they own. Russia says, if you're going to freeze our assets and not pay us, we're not going to pay you either. Western lenders will be affected. And Russia now has announced it'll cut off exports of important chemicals, metals, and processed gases to any nation that has sanctioned Russia. Incidentally, there are 13 countries in Europe that get 65% or more of the oil, 65% or more of their oil and gas from Russia. They cannot survive without Russian oil and gas. These exports, as Rickards points out, are indispensable to manufacturing processes, including semiconductors, automobiles, and agriculture. In the end, most of the economic pain will fall on Western manufacturing and farming. This is where the law of unintended consequences comes into play. 65% of the processed neon gas used to power lasers that make semiconductors comes from Ukraine. 65%. Between 35 and 50% of strategic metals like titanium and aluminum that are used in aircraft manufacture by Boeing and Airbus come from Russia. Much of the grain that feeds the Middle East and Africa comes from Ukraine or Russia. Russia also exports metals used in battery production for electronic vehicles, including lithium, cobalt, and nickel. The list goes on, topped by oil, natural gas, and coal, where Russia is the leading supplier to Europe, which I already mentioned. So if Russia follows through, Rickard says we're going to see a shutdown of major industries around the world. Semiconductors, which would affect automobiles, appliances, and electronics, to heavy equipment and transportation. Rickard says the Biden administration will find out the hard way that in a globalized, densely connected world, what happens in Russia doesn't stay in Russia. Russia may be the first victim of U.S. sanctions, but the entire world will pay the final price, and so will the dollar. Now, Rickards has a book that he mentions here, Currency Wars. It's a terrific book to read. It's almost prophetic. So if you haven't had a chance to read it, pick it up. It's by James Rickard, and the book is Currency Wars. In the book, he talks about the fact that in 2009, Rickards facilitated and participated in the first ever financial war game hosted by the Pentagon. The war game was conducted at the top secret Warfare Analysis Laboratory of the United States, which is located at the Applied Physics Laboratory about halfway between D.C. and Baltimore. Now, this really would be in the first two chapters of his Currency Wars book, which is now 11 years old. And in the book, he presented the same scenario that's playing out now. He said Russia and China would accumulate large gold reserves. They would pool their gold and launch a new digital currency backed by gold in place of the U.S. dollar. Russia and China would then insist that any purchases of Russian energy or Chinese manufactured goods be paid for in the new currency. It would be a clear-cut effort to get out from under the U.S. dollar and protect themselves from U.S. dollar-based economic sanctions. And that's exactly what we're seeing playing out today. Saudi Arabia sees it playing out as well, and they want to be on the right side of any currency changes. Now, Rickards points out that it took 33 years for the dollar to achieve its status as reserve currency. The dollar lost its gold link in 1971, but remained the leading reserve currency due in part to the petrodollar deal that we just discussed. The world was flooded with dollars because, one, the Fed was creating a lot of dollars, and two, the U.S. has operated with a chronic trade deficit for almost the entire past 50 years. The difficulties began in the 90s and early 2000s when the U.S. used financial sanctions to punish Iran, North Korea, and Venezuela. And this is the card that the U.S. always goes back to. It's financial warfare. And now the U.S. has frozen the reserves of the central bank and of China. They've crossed the line. This is the last straw for Russia and the world, according to Rickards, and I happen to think he might be right. He said, after all, and this is a really salient point, if dollar reserves are no longer a safe haven, then who's going to want them? The world will demand something more dependable that can't be frozen on U.S. whims. Rickards says the U.S. is destroying the value of the dollar by abusing sanctions, crossing lines they haven't crossed in the past, even in wartime. He said in the future, the dollar will not be that important. He said it won't happen overnight, but the unprecedented sanctions against Russia will only accelerate the process. Now, Lawrence Lepard, this is the last thing I want to talk about, and I have a lot of material to talk about today. This is my last topic. We're about a half hour in, but I had a lot I wanted to share with you this week because there's a lot going on in the world that will affect us, I believe, now probably sooner than many of us maybe have originally anticipated or had originally anticipated. Now, Lepard is a terrific analyst. Before Russia invaded Ukraine, Lepard predicted that a crack-up boom could be on its way. So this is what Lepard has said. he said what just happened in the last 2 weeks is enormously important and misunderstood by many investors. Now, I've tried to give you a synopsis of this over the last half hour. The Russian invasion of Ukraine and the corresponding Western sanctions and seizure of Russian reserves are nothing short of a monetary earthquake. Now, this is what Rickards talked about. This is what the Wall Street Journal article talked about. He said, nothing this big has happened since Nixon abandoned the gold standard in 1971. So this may indeed be a turning point. Russia, with the backing and support of China, just told the world it's no longer going to sell its oil, gas, and wheat for Western currencies, which are programmed to debase or devalue. The West responded by saying, okay, fine, be that way. If you have foreign exchange reserves held in our system, they're no longer safe if we don't like your politics. He said it's similar to what the Canadians did when they moved to seize the bank accounts of Canadians who had demonstrated support for the truckers without due process of law. Both these political moves, Lepard says, are blatant advertisements for what he calls non-state controlled money without counterparty risk, like gold and Bitcoin. I mean, if we can't trust dollar reserves, then we're going to use something else. Now, Lepard says gold is going to rip higher because of this. Now, we haven't seen it yet. We saw a big run up. It caused and triggered a rebalance in our portfolio, our strategic permanent portfolio, a little over a week ago. And since then, gold has pulled back and stocks have rallied. But I expect that this trend will continue again. Lepard says the U.S. dollar has been the reserve currency since the end of World War II and the Bretton Woods Agreement. We've talked about all that. Lepard references Charles de Gaulle here as well. He said, Putin is now cast in the role of Charles de Gaulle, who complained about the exorbitant privilege of the U.S. with its dollar hegemony. As we all know, de Gaulle demanded gold in exchange for France's U.S. dollar FX surpluses, and this is the outflow that forced Nixon to close the gold window. He said, Putin just shot King Dollar in the head. He said, we can now see it. We're seeing evidence of it as the price of everything commodity related is going up relentlessly when priced in U.S. dollars. Russia is long commodities, long gold, and they really don't need fiat currency, according to Lepard. Russia has a low debt to gross domestic product ratio. Russia also has low taxes. If the world financial markets collapse on a relative basis, the position of Russia, relatively speaking anyway, will be improved significantly. Lepard says he thinks this is Putin's endgame. He said, if you don't recognize this, you could be caught wrong-footed. He said a lot of investors are probably going to get caught. He said you need to own gold, real assets, and commodities. Well, I have suggested to many of you that you have up to 20% of your portfolio in physical precious metals. This is now becoming more important. Lepard says fiat currencies are going to fail spectacularly, and he thinks soon. Now, before Russia invaded Ukraine, we had Lepard predicting that a crack-up boom could be on the way. So now we have this invasion of Ukraine that has likely served as a catalyst for this. So what is a crack-up boom? A crack-up boom is the crash of the credit and monetary system because of continual credit expansion, continual currency creation, if you will, and consumer price inflation that just can't be sustained. So at the same time, you have an economic contraction. And as I talk about in the April You May Not Know report, we're starting to see economic contraction. The Atlanta Fed just said that first quarter growth rate, they estimate now, will be 0%. So this is from the article. Certainly some of the current rip-roaring inflation could abate as supply chain delivery times improve. But there's little evidence that that's happening. Perhaps there's something else going on. Labor and product supply shortages can easily lead to further price increases, and there's the potential for a vicious cost push spiral upward. And if this is really intense, if this cost push spiral upward happens so fast that businesses can't keep up with it, they soon maybe won't be able to operate and businesses may begin to fail. Historically, what happens in government responses is they try to create more currency and then impose cost controls. Now, we're seeing some of this now already, and I'll end with this. There's a lot of builders that can't get supplies they need to build houses. One builder in Las Vegas reported his cost of building a house went up 40% last quarter. That's going to make most builders very hesitant to invest in another house. We know of an interior designer who cannot source products. Furniture delivery times are 6 months plus, and prices are not even guaranteed. So if these inflationary expectations continue to grow, the path to this crack up will become clear. And right now, we're not seeing any policy that would reverse this. So again, I would suggest that if you've not already done so, you'll want to think about having 20% of your assets or so in physical metals. And that's really what I wanted to talk about today. I know I'm about 7 minutes over, but a lot to talk about and all related. So I hope you all found that explanation to be helpful and it gives you a perspective that's helpful. If you do have a question, I'll hang out just for a minute here, a comment. Go to the chat box on the right-hand side of your screen. Quick reminder, I noticed we had a lot of people jump on today after we got started. Next week, the Headline Roundup webinar will be recorded. We'll be back again live on April 4. Jeff, thank you for your nice words. Hope the presentation was helpful to everyone. And I will continue to do my best to keep you updated and continue to research what's going on. So, Jeff, yeah, thank you for the encouragement and the nice word. And Mark, I'm not seeing anything else. So we'll be back again next week recorded, be live in 2 weeks. I think we can go ahead, Mark, and conclude.